Good day, everyone. I know you don't normally see me talking about energy companies, but there's a very good reason I'm talking about Valero today. First, I was inspired by listening to a podcast, and in it, the podcast's makers were talking about an upcoming commodity cycle in 2024. And I already know that gold is tapping up against its all-time highs. I'm sure other metals and other commodities are doing similar actions. So it got me thinking about a really good, perfect hedge that I need for my public account. I have a bunch of MPW, which is Medical Properties Trust. So it's a REIT, and it just suffered a 30% loss. So after making a video on that, I decided I need to hedge my position a little bit with something that has the potential to run counter, given what could happen to rates in the upcoming year, right? So here's my reasoning before I go into the agenda. My reasoning is that I wanted an energy play to counter the housing because if rates go stay the same, that probably means that the commodities are experiencing a high surge in prices, and it is unlikely that the Federal Reserve will cut their interest rates down, which would help the housing sector, especially the commercial housing sector, and even more specifically MPW or MPT, which is the trust that is experiencing lots of troubles and their debt is becoming a burden. So they need, an act from above to try to, you know, um, shore in their balance sheet. So that got me thinking about hedges, and I think Valero is a perfect one because I've heard someone else talk about the company before. I looked into it a little bit. I was just checking things through filters and other tools, and I saw that they actually have a price to earnings ratio of about 4.4 or something like that at the moment. I know that's inflated because last year, the previous year was much better for the energy companies than this last year, but even with the last year's numbers, the company's still doing pretty well. So here's what I'm going to do. I'll do a quick glance, and I've already just explained the function of the position that is going to serve in my account is going to be a hedge position, to make sure it protects me against upside commodity pricing that will keep interest rates high for a prolonged period of time, which would decimate my commercial, hospital, real estate positions. So I need that hedge, and I think Valero is a perfect company for that. I don't like to deal in ETFs that group other stocks together because I think it's a little bit, intellectually lazy. Although it's probably better, you know, unless you're some super mega researcher or an analyst, which I'm not, but I have the aspirations to try to become good at the market. So I don't want to deal with ETFs. I prefer to do the work myself. So after I take a quick glance at the company, I want to talk about some cash management decisions that I noticed looking through their 10Qs. I think it's very interesting to know what we're dealing with when it comes to management. You can glean as to how good or what the management is thinking by their actions. So I think that would be good. Also, dividend mentality. The reason I said mentality here is because, again, I'm trying to understand the management from the little research that I've done. I guess not that little, but it's not as in depth of somebody who studies all companies day in and day out. I'm sure there are many analysts that are much more specialized. I'm not an official analyst, by the way. I'm just an individual investor, just like you. I'm sure there are plenty of analysts that are much more specialized in the field, but from a generalist perspective, I think I can bring some value here on the analysis from that lens, because a lot of the oil and gas or commodity experts, they view the markets from their specific lens, and they kind of sometimes miss the big picture. I used to be one of those. Again, not an official analyst, but I used to be very involved in the silver markets, precious metal markets, the dry bulk shipping, container ships markets, the Baltic indexes, right? And I was very tunnel visioned when it comes to those markets, and I missed the big picture. So now I'm really trying to step back, make sure I analyze things from a more broader perspective. So after that, I'm going to show you my exact move and entry price that I'm looking for in Valero. So without further ado, let's move on to stockanalysis.com. This is the website that I'm going to be using today. No, I'm not affiliated with them. I just think it's a great tool to do a quick glance at companies. Now, immediately, we're going to notice that today the company was down 1%. If we pull it out to 1 month, it's up 3.5%. 1 year, it's about flat. 5 years, it starts to get interesting. You can see how ever since 2020, the beginning of 2021, the company has experienced basically a steady rise in stock price. It is bumping up against resistance at this, 140, 145 level, I guess. However, it's making higher lows from a technical perspective. I'm not a technician either, okay? But I'm just, if you look at it from a jack of all trades type of perspective, you want to be aware of everything, at least the basics. You'll see that it's scoring higher lows, and the numbers are going to support that movement. And I think it has some more action to go. The more you bump up against that resistance, the higher the chance it will break through. So enough technicals. Let's go into the financials. Before we talk about dividends or anything like that, I like to put on under quarterly. So the definition is quite a bit higher. You can extract much more perspective and information from that kind of defined higher definition view. So these are the revenues. There is a small uptick in revenue here that's kind of promising in the last reporting quarter, all the way back, 3 months ago or so. And the cost of revenue, though, also was a little bit higher, which is fine. The operating income was 3.5 billion, which is really, really massive for the size of the company. Net income 2.62 billion. And you can see why the PE is so high, because in 2021, 2022, these guys were making like 2-3 billion per quarter, which is extremely high. And that would make it like 12 billion per year, and their valuation at the moment is like 43 billion or something like that. So you can see how that PE ratio is so skyrocketing, or it's so tremendously high. So now I'm gonna go into some management decisions, some important metrics that I observe whenever I try to figure out what management is thinking. Before I go down further into the financials, I want to first talk about the cash. So some quick statistics. We're going to jump onto the statistics tab. You can see the valuation here. Market cap is 44 billion at the moment. Enterprise value is 50 billion, which tells me that they have about a $6 billion debt, net debt. If we look at some of the metrics, the P ratio here is at 4.4, which is crazy. Forward P of 8, which is to be expected. It's probably going to happen. Price to sales ratio of 0.3. Price to free cash flow is amazing at 4.21. That's really good. And here are the enterprise value metrics. And then something that I think is really good to look at here is, look at this, return on equity 42.8. These percentages, just at a quick glance, can tell you a lot about the company. Return on assets 17.5. Return on invested capital is almost 30%. Revenue per employee is 15 million. Profits per employee is 1.1 million. That's really good ratio here. So, they paid 23.5% income tax last year. These more margin statistics here. Gross margin is 10.4%. Operating margin 9.66%. Pre-tax margin 9.3%. Profit margin at 7.11%, which is great, I think. Anyways. So furthermore, let's go into the cash positions here for a moment. So here's the consolidated balance sheet, basically a quick overview of the balance sheet. Let me see if you can see it properly. All right, sorry for those of you who are on the phone, you may have to zoom in somehow, or watch this on a desktop, or you can just visit the website yourself and check the stuff out. But the cash and cash equivalent, so this number is important to me. They got $6 billion of cash, and so we're going to be looking at what exactly they're doing with their cash, which is going to tell me a lot about the mentality of the management team. Okay, total debt at the moment is 11.44 billion. and net cash is 5.61 billion, negative 5.61 billion. So their debt, $5.5 billion. So the first signal, okay, to tell me what this company is doing with their cash is the shares outstanding. So we're going to look at shares outstanding, and you can see that ever since 2021, with their newfound cash hoard, they've decided to start buying back shares. Now, this is not something new to the company. Yes, they stopped doing that at 2018-19, and the share count's basically been flat up until 2022, and then they resumed buying back shares. So that serves a pretty interesting function for the company. So they're basically increasing the percentage ownership of the company to the shareholders, right? So the less shares outstand, the less shares out there, the higher percentage the company shareholder does have. So that's great. However, they own a greater percentage of a smaller company now because the cash is no longer there. It's retiring shares. And so, you know, there's less cash in the company. So it's a smaller company, but you own, a greater percentage of this cash generating company. So I guess it's a net positive. Another thing that's good about buying back shares is that if you treat it like a debt, basically, they spit out a dividend, right? So if the dividend is, let's say, 4%, you're in effect retiring a perpetual debt of having to pay 4% over and over and over again, okay? Like, let's say a really long-term bond. Like, let's say you're committed to paying 4% dividend and you take out a 100-year bond. Let's say the company is going to be living for 100 years. Sorry about that. Let's see if I messed up the mic here. Sound okay? And so you're retiring that bond, basically. So you're off the hook. You don't have to pay. So it serves a pretty good purpose here. And now you have even more cash to play with moving forward, and you're in a better financial position to take on more debt in the future if you need it for an acquisition or something like that, or just to survive a really tough period. So that's fantastic. So that already tells me that the management is really looking out after the shareholders. It's telling me that they're trying to make good on the good times and make sure that they put themselves in a better position for the future. And that theme runs across through the rest of the metrics. So if I go to the dividends, you'll see that they have a 3.16% dividend yield at the moment, and they're growing the dividend on average of 4% per year, which is about on pace with inflation, I would say. The payout ratio is 13.93, which tells me that they have so much room to increase the dividend, but they're not doing it. And if they do increase the dividend, it's not going to be by that much. I bet they will increase it soon if they haven't already announced an increase. Last time they increased it in February, so they're probably going to increase it in the beginning of this year if they haven't announced it already. But I don't see an announcement here. I quickly scrolled through some of the most recent news articles, but I don't see it. So, but they will do it. They'll do it. So it's not going to be a 3.16 dividend yield. It's going to be higher unless the price matches that and increase further. So here's another insight into what the management's thinking. Look at these dividend increases. They've never decreased the dividend, even though the company's got some bad times, especially in the 2020 crash. They chose not to decrease the dividend, and that would have been a really, really terrific time to buy this company, I think. Let's look at the stock price real quick. If we pull it out to the 5 years, yeah, in 2020, this company was basically, $38 at the bottom there. And man, that would have been a great buy, right? Especially considering the dividend yield you'd be getting right now. You'd be getting probably, $38, so times more than times 3, like close to 10% dividend you'd be getting on your initial investment at the moment, and growing. So it tells me that, even though they have plenty of cash to raise the dividend, they chose not to rush into raising it very high, and they're probably going to do another minor raise here. You can see how the growth of the dividend as a percentage has kind of flatlined here. They try not to like overdo it like they did back in 2015, for example. Although you could argue they didn't overdo it because it's sustained. So further, what I want to talk about. Okay, so on the financials, on the balance sheet, here's what I want to talk about here. This is their cash. It keeps growing. Okay, so total assets, it's growing. Let's see if the liabilities match. Yeah, but they're not growing as fast. So assets to liabilities is definitely improving. So shareholder equity should be growing a little bit, and it is by a slight amount. Total debt. So this is another important number here. What are they doing with their debt? So you can see that they have been using their extra cash not only to buy shares, but also to reduce their total debt to improve the balance sheet of the company. So they really care about keeping this company healthy. There's a slight uptick in debt here in the last quarter, but in general, the trend is to reduce debt, which I applaud. Would rather not, have this 2020 debt linger forever. However, this is what I want to talk about mainly. Under their 10Q here, under their quarterly report, I'm looking at all the debt they have retired, and I'm questioning some of these decisions. So please, if you're an expert on Valero, I want you to comment down below on the video and tell me what the management is thinking here when they're retiring this debt. In my opinion, anything under 5% basically, or under, let's say 4.5%, 4%, you should not be retiring. I mean, they could try their best to enter like the short-term, money markets and get like 5% on their cash currently. They can always, retire that, maybe that long-term debt, they could always retire later. I mean, they could be making positive cash flow on the spread right now on these notes. So I don't know, shed some light on these decisions, but you can see that they retired 3.65 yielding notes due in 2025, 2.85. That's really low. I mean, that's a big asset to have. We might not see rates like that for quite some time, and they decided to retire this debt. So that's a questionable decision from my end. Then 4.375, okay, fine, that's fine. 3.4, this is really favorable rate. 4.3, 4%. And there's more that they retired. 650 million here. Of 3.65, again 2.850, 4.375, and 3.4 senior notes due in 2026. So I don't know, especially this one here, 2.850, and some of these longer dated ones like this one 2026, or even this one in 2029. I mean, I would think you would try to keep that. So that's a little bit of a question mark for me personally when it comes to their decision making. Okay, so we covered cash management decisions, dividend mentality, and now I'm going to talk about the exact move that I plan on doing with Valero. Okay, so we're going to go into my public account here that I share regularly, and we're going to go into Valero. Sorry, one sec. Let me switch here. Doing this on the fly. All right, so Valero, and then we're going to go to options. And I was studying the option wheel here to try to figure out some of the pricing. And if I wanted to sell puts, let's say on February 16th, I was looking at the 125 strike price, and I could be collecting $380 per contracts. So I was thinking of maybe selling a couple of those contracts and gaining, like $760 for waiting until February and trying to get a better price on Valero. Worst case scenario, I will be getting $760. And best case scenario, I mean, I don't know if it's the best case scenario, but if the price happens to drop below 125, I will have 200 shares of Valero that I can use to hedge my properties trust position. So that's the move. I'm thinking of that this is the best way to go. I'm going to be doing this on margin. So the margin is pretty high right now, considering the base rate is 5%. Margins on Robinhood at least are 8%. Don't rag on Robinhood. Okay, it's a good platform. I know they've had iffy past and they're associated with like, quick scammy day traders and whatnot, but it's actually a really good platform. It offers 24-hour trading and stuff like that. I'm not paid by Robinhood, not affiliated, okay? but I actually think it's a very good platform. 24-hour trading is not offered in any other platform, and you can exit or enter positions, although at a more illiquid manner, through the night if you need to. If you wake up at 1 a.m. in the morning and you're in cold sweats and you need to dump a position, you can do that. You can buy some Apple at 11 p.m. Do whatever you want to do. There are plenty of stocks and indexes now that are traded on, and so. But that's just one reason. They also have very competitive rates when it comes to margin. So the margin currently anyway is about 8%, which is steep. So I need to make sure that I'm being compensated for that. So I have to use options to try to make up for the difference, and I gotta sell puts, and that was gonna not only get me a price that will have a better dividend, but also I plan on selling calls, covered calls against my position. This is not options tutorial here, but if you already understand options, then you know what I'm talking about. Then I'll try to sell call options against my position to try to cover the interest on the margin expense. And I'm going to be betting basically that the company doesn't have a big swift drop, which then I'm going to be paying for dearly. Okay, so that's the plan. Hopefully this was a little bit informative and tells you why I choose Valero as a hedge. Make sure that you make your own due diligence whenever you do any research on any company. If you're confused about anything, please consult a financial advisor. Make your own independent judgments. I'm not responsible for any loss or gain that you may experience as a result of following what is said on this video. All right. So with that said, hope this helped. Peace out.